U.S. economic is coming. China is aiming to overthrow the U.S. dollar as the currency of choice for the oil market, a move that could have far-reaching consequences. Since the 1970s, the oil trade has almost entirely been conducted in U.S. dollars, even when buyers and producers are not American. The ramifications of the dollar-denominated oil trade are immense because oil is priced in dollars. There is huge demand for dollars, lending the U.S. economic and strategic power. Beijing hopes to challenge the dollar by setting up a futures market with its own currency, the yuan. To that end, reports indicate that China is set to introduce an oil benchmark priced in yuan in the coming months. For China, there are a lot of upsides to this gambit. An oil futures market based in yuan will stimulate demand for the Chinese currency, which China believes will lend its strategic clout. That money is also more likely to be recycled back into the Chinese economy. The U.S. has been able to run huge budget deficits, borrowing money at extremely low rates, because of the demand for its currency. Petrodollars continuously flow back into the U.S. economy, creating investment and economic growth that might not otherwise occur. The dollar has also long been one of the premier safe havens for investors around the world. China hopes to replicate this dynamic. And as the largest oil importer in the world, there is a great deal of logic in having oil contracts trade in yuan. But it won't be easy to unseat the greenback. The plan is to launch an oil futures contract on the Shanghai International Energy Exchange, INE, but there are obstacles in convincing large oil producers and consumers in using the yuan and investing in the Shanghai benchmark. Without some major countries participating, like, say, Saudi Arabia or Russia, it will be difficult to create a market that is deep and liquid enough to make a difference. Moreover, because the yuan does not float freely, it is fixed to the dollar, and adjusted daily, major investors will be wary of trading in the Chinese currency. My biggest reservations are the role of the Chinese central government, potential state intervention, and favoritism toward Chinese companies, said John Driscoll, director of JTD Energy Services, according to CNBC. On the other hand, China has slowly loosened its grip on its currency. Game changer it is not, at least not yet, Gal Luft, co-director of the Institute for the Analysis of Global Security, told CNBC. But it is another indicator of the beginning of the glacial, and I emphasize the word glacial, decline of the dollar. Others see much more dramatic change coming from the launching of the Shanghai benchmark. Weir Keiser, Managing Director and Chief Investment Officer of asset manager Swiss Asia Capital, told CNBC that the petro-yuan is well advanced and already structurally in place. Up until now, there have been some transactions in yuan, but only in trade specifically with China, and typically only with some smaller countries. Iran in particular was an early adopter of yuan-based oil sales, an unsurprising fact given Tehran's eagerness to avoid the long arm of the U.S. Treasury Department. A more significant development was Russia agreeing to some yuan-based oil trade in 2015, also the result of U.S. sanctions. Many believe that key to the success of the benchmark is convincing a country, like Saudi Arabia, to participate. Saudi Arabia is one of the largest oil producers in the world and sells a little more than 1 million barrels of oil each day to China. Russia is still the top supplier to China, exporting 545 megabytes/d in September, and in fact, Russia has been taking market share away from Saudi Arabia in China. If Riyadh wants to avoid losing more ground, the thinking goes, it may need to agree to yuan-denominated sales. Recent reports that China's large state-owned oil companies are considering an outright purchase of 5% of Saudi Aramco, a move that Saudi Arabia is rumored to be considering in lieu of the Aramco IPO, should be seen in this context. I believe that yuan pricing of oil is coming, and as soon as the Saudis move to accept it, as the Chinese will compel them to do, then the rest of the oil market will move along with them, Carl Weinberg, chief economist at High Frequency Economics, said on CNBC earlier this month. At that point, things would really start to change, and the dollar would start to lose its top status. Some see that as unlikely, as Saudi Arabia would likely be met with blowback from the U.S., but it would be a difficult choice for Riyadh to lose the Chinese market or spark the ire of Washington. It may not happen right away, but the launching of the crude oil benchmark on the Shanghai exchange could mark the beginning of the end of the petrodollar. China wants to dethrone the dollar, and it could take a step in that direction before the end of the year. According to numerous reports, China is prepared to launch a yuan-denominated oil futures contract before Christmas. Last week, the Shanghai International Energy Exchange successfully completed a fifth round of yuan-backed oil futures testing. According to a report by RT, the organization has met all the listing requirements and is set for an official launch. Chinese trader Yuan Kuai told Bloomberg the holiday season would be the perfect time to get oil trading in yuan off the ground. An official launch during Christmas would be appropriate. The Western market would be quiet and allow the Shanghai exchange as well as Chinese investors to adjust in the early days. This could be a nightmare before Christmas for the petrodollar. In June, China took the first step toward establishing a petro-yuan when it launched a direct trade relationship with Russia, allowing oil purchases to be made strictly in the Chinese currency. But China faces hurdles as it tries to establish similar relationships with other oil exporters. The yuan is still widely viewed as unstable and illiquid. Economist Yao Wei told Bloomberg the yuan-based contract has the potential to greatly help China's push for yuan internationalization, but Bloomberg noted the hurdles the Chinese face. As the world's largest energy consumer and an increasing source of investment capital for oil-producing nations, China has an interest in using its own currency rather than that of a geopolitical competitor. One hurdle for setting up a rival to Brent or West Texas Intermediate, overseas oil producers and traders would need to swallow China's capital controls and penchant for occasional market interventions. To help allay international fears, China may back some yuan-based oil contracts with gold. Last fall, the Chinese announced the launch of a gold-backed, yuan-denominated oil futures contract. These contracts would be priced in yuan but convertible to gold. As Alistair MacLeod, head of research at Gold Money, told the Asian Review, including an option to have the contract paid in physical gold would ease some of the wariness oil exporters have about the yuan. It is a mechanism which is likely to appeal to oil producers that prefer to avoid using dollars and are not ready to accept that being paid in yuan for oil sales to China is a good idea either. A successful gold-backed Chinese petro-yuan could be bad news for the US dollar and for the broader US economy. The dollar's strength is highly dependent on its use as an oil trade vehicle. If the yuan begins to undermine the dollar's position, we could see a steady decline in the greenback. While the rise of the petro-yuan is a nightmare for the dollar, it could be good news for gold. If the Chinese gold-backed, yuan-denominated oil futures contracts prove successful, it could push the yellow metal higher, as the petro-yuan further erodes the strength of the dollar. And as Newsmax reported, the Chinese move is significant for gold in a more basic sense. For the first time since our nation abandoned the gold standard decades ago, physical gold is being reintroduced to the global monetary system in a major way. That alone is incredibly good news for gold owners.